Is Moody's downgrade just the beginning of something much bigger? Are the markets still headed to all-time highs, or are we about to retest the April lows? And if you felt like patterns that should be playing out haven't been, you're not alone, and I may have an answer for you. Join me as we cover analysis on SPY, QQQ, IWM, the VIX, and more. Nothing I say is financial advice. These are just my thoughts, opinions, and cats. Welcome back, cool cats. I'm going on vacation starting this week, so I've got something extra special I'm sharing in this video. I won't be posting a video next Sunday, but will very likely share thoughts and setups throughout the week on social. So if you haven't already, please make sure you've subscribed with notifications and follow me on StockTwits and X so you won't miss any market moving updates. As we've covered before, the pattern target for this symmetrical triangle here in purple was around 602, which was confluent with supply if we look left. And if the bullish megaphone was in play, it's literally targeting the main resistance line in red around 625. And if you don't know the significance of this line, it goes back for many years. We got pretty close to completing the symmetrical triangle pattern target, but as many of you now know, Moody's came out right after the bell on Friday and downgraded the US credit rating. For those who don't know what that means, it means that due to fiscal irresponsibility and uncertainty surrounding our debt, they've deemed US Treasuries just a little bit less safe than before, which is honestly a pretty bad thing because if other nations and investors decided that not to buy our Treasuries, yields would skyrocket and the Fed would have to step in and be the buyer of last resort, or else homes, cars, etc. would become absolutely unaffordable. So the question is, which do you sacrifice, the dollar or the bond market? They would probably sacrifice the dollar. So technically speaking, the next support is the upper part of this extended channel here in light green, around 582. And then the extended support line of the symmetrical triangle, around 580, depending on where it got hit. Zooming out on the daily, if we were to break those supports, the 100 and the 200-day simple moving averages here in blue and purple will be converging around key levels between about 574 and 578, where they could act as very strong support. If those didn't hold as support, the 50-week simple moving average is around 570. And this very key level of roughly 565 is just below it. And if we throw up the RSI, didn't I say that once the RSI came back up and hit the lower support line of this ascending RSI triangle, that it could absolutely act as resistance? So for those who say that RSI patterns don't work, just send my video their way. The symmetrical triangle pattern target on QQQ is around 528. But as I've been saying, we would first have to get above the previous support line of this multi-year bullish channel in purple, which goes all the way back to July of 2023. When we zoom back in on the 4-hour, we can see that QQQ was showing very obvious signs of bearish divergence leading up into Friday. And it could come down to try to fill this fair value gap down to around 505.30, which is also a key level and above this demand zone. If that support didn't hold, it could try to retest this previous support line of the symmetrical triangle around 499 to 501, depending on where it got hit. QQQ's 100 and 200-day simple moving averages are spread a little wider than SPY's, with the 100-day being around 496.70 and the 200-day being around 492.50. Either one of these could act as support if we head back down there, and sometimes you can even overshoot a moving average, but it acts like a magnet and pulls price back up. And if we start seeing major supports getting broken left and right, I'll try my best to send out an emergency market update. But if you've been following me for a while, you should already know where the key levels are. YouTube tells me that 46% of you who watch my videos haven't subscribed yet. And I've got to say, I really feel like you're missing out. Every episode is a little different, and I don't just give you key levels and patterns. I explain how I arrived at different conclusions so that you can be more confident to do analysis yourself. And some episodes are jam-packed with super helpful info. It only takes a second to click subscribe and that little bell, and then you're all set. I mentioned in my last video, linked above, that IWM had already broken below its support line that started on April 9th. and was also below this strong supply zone highlighted in orange. And it definitely appears to be struggling here, but at the same time, it has only completed about half of its pattern target of this big bullish megaphone pattern that we've been covering, which is targeting roughly 225, just below this very important supply zone. So I have to wonder if, after a pullback, and maybe a pretty sharp pullback, it doesn't decide to keep pumping up and through the supply in the coming weeks. If it were to start falling, the next support is around 199.50 to 200 even. That's major, with minor levels below that around 195 and 191, basically in increments of 5. And then down here around 187 to 188 is very strong. As we can see, if we look left, it was very hard to get above that. And when we finally did and came back and back tested it, it definitely acted as support. On the daily, the 10 simple moving average here in light green could act as support around 203.50. And IWM has yet to retest its 200-day simple moving average around 216. And I don't think it's just a coincidence that it will basically be right at the top of this supply zone, where price could reject very sharply without a seriously major bullish catalyst. Looking at Dixie, the dollar strength index, a lot of people are very bearish on the dollar right now, and they have multiple reasons to be, since all of the geopolitical uncertainty lately has made the US dollar a less attractive place to park one's capital and threaten faith in US treasuries. But it has been showing pretty decent bullishness, making higher lows and higher highs ever since touching this significant trend line in yellow, which we've covered multiple times before, which we can see if we zoom out on the daily. This goes all the way back to 2022. If Dixie can break the resistance line of this long-running bearish channel in light blue around 101.30, then it opens the door up to about 103.30, which would fill this fair value gap right here that occurred on April 10th. And this whole shaded green area is a supply zone. So if it can also break above roughly 102 even, it could flip supply into demand. And one could argue that it's already trying to do that. On the bearish side, if this resistance holds up, Dixie could continue this downtrend. And I've covered in my previous videos, but if that happens, zooming out on the daily, my thesis is that Dixie will hit this major trend line in green right around where it would converge also with this yellow trend line around 97 even. And we could see a very strong bounce from there. You might even say it would be an aggressive bounce. But if it didn't bounce from there, and if this didn't hold a support, as I've shared multiple times in other videos, this massive symmetrical triangle that goes all the way back to 2001 could begin to play out, and we could see dollar strength start to tank like never before. Taking a look at the VIX on the 4-hour, I mentioned in a recent post that roughly 15 to 1550 here in orange was the next major support level on the VIX, but 1750, roughly 1750, is a minor support level, which you can see we've already broken below that, but I'm sure it hasn't had time to catch up with Moody's downgrade yet. And we can also see how the VIX has been forming pretty obvious bullish divergence here, where the RSI made a higher low while price made a slightly lower low. It's yet to be seen how the Moody's downgrade is really going to affect the markets, but the first level of resistance will be around 20, touching this previous support line in light green that goes all the way back to February 21st, and then the multi-year resistance line in red right here around 2130. If it could get above that, it could be going back up to fill the gap from May 12th, where SPY gapped above its 200-day simple moving average. Alternatively, though, I still think 15 to 1550 is where we could potentially see some real sparks fly. And if the VIX ever manages to get back down to roughly about 11 even, I'll be loading up on VIX calls like there's no tomorrow. And if you're wondering why, here's the reason. Because this main support line that goes all the way back to 2021 has acted as very strong support every time it's been hit. If you've been following my videos and posts, you already know about this big symmetrical triangle on the ADD market breadth indicator. And unless this breaks out next week, the market is likely in for some volatility, where we're going to see downswings followed by upswings and back again as the overall market is trying to pick a direction. And it's all centered around Nvidia's earnings. My guess is that option strategies that benefit off of price staying within a range, like short iron condors, etc., may benefit next week so long as this doesn't break out, but that would definitely be taking a big risk. And I'll say again, so long as it doesn't break out. We really need to see how the Moody's downgrade plays out, especially if it causes 10-year yields to break that all-important 5% threshold. So here's my big surprise, and please bear with me as I lay everything out. On April 2nd, 2025 was Liberation Day, where Trump held up his big, beautiful sign showing all of the massive tariffs that he would enact on all of the other countries. It sparked this massive sell-off. Then on April 7th, a rumor spread that Trump was going to pause tariffs for 90 days, conveniently as SPY hit this major support line of the bullish channel that goes back to 2008. We've covered that before. But for those who have missed it, it's this channel here in green, which you can see it delineated many upward and downward moves. So it's a very strong channel and a very strong support line. And the rumor also happened to come out just as treasury yields were also spiraling up. One of my good trading buddies also pointed out that April 9th was historically a very bullish day, and that they might have accidentally leaked info 2 days early. Or I think it's also quite possible that they saw that this was about to break this very important level, and they knew if it broke that all hell could break loose. Then on April 9th, Trump actually came out on Truth Social and said this is a great time to buy, signed DJT, shortly before announcing the 90-day pause on multiple tariffs. Then on April 22nd, we had Tesla earnings come out after the bell. They were bad earnings, but Elon announced that he's going down to only working on Doge up to 2 days a week, at the same time that Trump magically went from calling the Fed chair too late Powell and talking about how easy it would be to get rid of him to saying that I've got no plans to fire him, as well as other bullish headlines came out right after the bell. And I don't think that was just a coincidence. And then from April 28th through April 30th, when this rising wedge here in yellow should have been playing out and at least hit the extended support line of the symmetrical triangle, instead we just traded sideways. On April 29th, per Bloomberg, JP Morgan traders turned bullish on US stocks. And then on April 30th, we had Meta earnings that were coming out after the bell. And even though the market had started to sell off, once we hit this previous downtrend line that started on February 21st, it treated it as support and bounced up aggressively. And Meta's earnings were amazing, so the markets definitely continued to push up afterwards. On May 8th, Trump posted again urging investors to buy stocks, which invalidated the drop from this rising wedge in purple, which was targeting about 549 on SPY, and would have had it again hitting the extended support line of the symmetrical triangle here. I have to zoom out on the daily to show you, but SPY had been struggling with its 200-day simple moving average, which you don't see the full range of price action because a lot of this was in extended hours. But on May 12th, US and China representatives met in Geneva and agreed on a deal to drastically lower tariffs on each other for 90 days, right as the market was at its 200-day simple moving average, right around this key level of 565, and beginning to show signs of weakness. And the market gapped above all of that resistance, trapping anybody who went short thinking that it would be strong enough resistance to at least see a decent pullback. And if you follow what Unusual Whales has been sharing, there has absolutely been insider trading before a lot of these major moves. And even on the way down, there also appeared to be well-timed bearish headlines and social media posts like Canada's going to become the 51st state and we want to take over Greenland. Things that were bound to make the market sell off due to uncertainty. And the whole time that the market was dropping, the VIX was slowly and methodically moving up. If we hop back over to the VIX, for weeks I had been pointing out this giant descending triangle here and what its pattern target was, and stating that this smaller descending triangle was probably going to be what kicked it off and broke the VIX above these key resistance levels. And I was right. February 21st is when the market began to start selling off, and it's when it broke this pattern. But you see how it started moving up in this very well-defined channel here in orange? Then it moved back down in a well-defined channel here in light blue. Then on March 28th, we got a hot inflation reading and weak consumer sentiment, which pushed the VIX back above this multi-year trend line in dark red, and then things really kicked off with quote-unquote Liberation Day. Telling you the selling pressure was controlled, and it appears that even the buying was also controlled to push the overall market down to key levels and below key supports. So at least on my news feed, the majority of headlines coming out during this time frame have been bearish, talking about recession fears, talks of WAR, inflation fears, etc., with just a few bullish headlines thrown in there. You've got increasing job layoffs, loss of full-time work replaced with gig work. College grads are lucky to get a job that pays what they want. Student loan repayments will start garnishing wages. CEO recession fears, consumer sentiment lows, credit delinquencies on the rise, people using buy now, pay later for groceries. Homes unaffordable with supply ramping up while demand stays low, meaning home prices could crash, and the list goes on. And yet, the market has not only shrugged off those headlines, but it appears it has been using shorts for fuel in this whole rally, which could absolutely explain how we essentially have gotten a V-shaped recovery. But here's the thing, if this was all a short-fueled rally, what happens once enough people turn bullish? Hint, hint, rug pull. And so what's the main point in covering all this and pointing all these things out? It's to point out the importance of technical levels, which seemingly predict the headlines instead of the other way around. It's just something to think about and digest. Stick around for today's trading rule to live by. Best of luck, cool cats, God bless, and please wish me and my family a happy vacation by liking the video, sharing with someone who might like it, and subscribing with notifications so you won't miss the next time I post.